This week we will be looking into the evolutions of benchmark rates. So benchmark interest rates are integral to the global financial systems. It is serving as a reference point for a vast array of financial instruments, including loans, mortgages, and derivatives. These rates influence the cost of borrowing and impact economic activities worldwide. Over the past few decades, significant changes have occurred in how these benchmarks are determined and used, prompting a transition to new systems. In these lectures, we will be looking into the evolutions of benchmark rates, the reason behind the changes, and their implications for financial markets. So, agenda for today's sections will be introductions to benchmark rates, the historical overview. We'll look into the reason for these evolutions, why there has been changes that has happened, the transitions to new benchmark rates, the impact on financial markets. So these transitions have their impact on the financials market, and we will be looking into the future outlooks as well. Let's look into the introductions to benchmark rates. The benchmark rates are standard interest rates that serve as reference points for various financial transactions. They provide transparency and consistency in financial markets, enabling investors and institutions to assess market conditions and make informed decisions. By setting a common ground for interest rates, benchmark facilitates the smooth functioning of lending, borrowing, and investment activities globally. Its significance is that it is used for pricing financial instruments. So it is used to determine the interest payments on loans, mortgage, bonds, and derivatives. It is also used as an economic indicator to reflect the health of a financial systems and influence the monetary policies decisions have on these financial system. It shows the trust in the reference rate as well, and those trust comes from the confidence in the financial transactions. Let's look into how the evolutions for the LIBOR has the benchmark rates have happened, and let's look into the history of it. So LIBOR LIBOR is a London Interbank Offered Rate. It was established in 1980s, and it became the primary global benchmark for short-term interest rate. So it was used for primarily for uh, overnight till 1 year, generally for a few months, couple of months for five major currencies, and it has the influence on more than $350 trillion of financial contracts at its peak. And it includes these LIBOR was used as a reference benchmarks for mortgages, student loans, corporate loans, and financial derivatives. The other traditional benchmark that was used was Euro LIBOR, that is Euro Interbank Offered Rate. It was introduced in Euro in 1999, and it reflects the rates in Eurozone. And there was a Tokyo Interbank Offered Rate, TIBOR. It was used in Japan. It was reflecting the Tokyo interbank markets. These benchmarks played a crucial role in standardizing interest rates worldwide and acted as barometers for the health of the banking sector. Let's look into the changes, why the changes was necessary. So there was several factors prompted the need to evolve from traditional benchmark rates into LIBOR. Traditional benchmark rates, LIBOR, like LIBORs, to current benchmark rates like risk-free rates that is getting used. So there was manipulations scandals that was revealed in 2012, where investigations revealed that some banks manipulated their LIBOR submissions to benefit trading positions and appear more creditworthy. And these LIBOR scandals resulted in billions in fine. So the bank who were involved in the manipulations, they were faced regulatory penalties. It has eroded the trust in the systems. So the credibility of LIBOR was significantly damaged because of these scandals, and it increases the regulatory scrutiny as well. So authority demanded more reliable benchmarks. There was other factors as well. So in the 2008 financial crisis, it has reduced the unsecured interbank lending as banks become more risk averse because they do not know whether the other banks will be able to repay back or not, whether they will be able to survive or not. So it reduces the transactions volume. LIBOR rates were become less and less reflective of actual market conditions because the reference was getting used for a lot of financial instruments, but the actual transactions that was not happening. So it becomes more like an estimate than the real market data. Also, there was regulatory pressures as well. So authorities worldwide were looking for a new benchmarks which is transparent, robust, and compliant with new standards. And there was technological advances that has happened which has improved the real time data collections, and the analytics part has also, the computation analytics part has evolved uh, tremendously. So it has facilitated the improved data collections analysis for the new developed benchmark. So let's look into the transitions to new benchmark rate. So in response to the shortcoming that we just saw in the traditional benchmarks, the financial industries began transitions to risk-free rates. In short, it is called RFRs. These new benchmarks are transactions based. So it was derived on actual market transactions. Earlier, LIBOR used to be derived on the estimations from uh, the group of banks. Now these transactions are based on the actual market transactions that has happened, and it was overnight. So it was for the actual overnight borrowing between interbank, and based on the rates that is getting defined there, the RFRs rate, the new benchmark rate was calculating, and it has the minimum credit risk because it was overnight. So the credit risk was very minimum. The new benchmark rates that has evolved uh, af- um, after LIBOR is so far the secured overnight financing rate. This is used in US. So it is based on overnight loan collateralized by US Treasury securities, and it has uh, very high transactions volume, around $1 trillion of daily transactions. So it has created uh, a bit more trust and robustness in the systems. Then we have Sonia, a Sterling overnight index average. This is used in UK. It also reflects the uh, overnight transactions, but this is based on unsecured transactions. It was broadened to include the wider range of transactions for greater accuracies. Then we have the Euro STR, the Euro short term rates, and this is used in Eurozone. It is based on wholesale Euro unsecured overnight borrowing costs, and it provides consistent measures across the Euro area. We have Saron, which is the used in Switzerland. This is Swiss average overnight rate. This is also based on Swiss repo market, just like so far. So this is based on secure transactions, and this is highly transparent. And we have the Tokyo overnight average rates that is used in Japan's as well. This reflect uncollateralized overnight call rates, and this is also based on actual transactions. So this increases the reliabilities in the benchmarks. So the key characteristics of risk-free rates is it is transactions based. So it is based on overnight actual transactions, and this has become more robust and transparent. Let's compare the old and new benchmarks. So old benchmark rate was the LIBOR and the new benchmark rate is risk-free rates. In the LIBOR, it was forward-looking term rates and it was based on estimates from panel of banks. So there are few banks which was providing the estimates, and because of which there's a scandals has happened as well, and it includes the credit risk as well. The new risk-free rates, it is the backward-looking overnight rates because it is based on actual transactions, and it has the minimum credit risk because this is based on overnight transactions data. The advantage of RFR is that it has reduced the manipulations risk because this is based on actual transactions data, and a lot of transactions now is happening on these RFRs, and regulations are also basically encouraging people to adopt these RFRs, and because of these liquidities it has increases the stabilities in the systems as well. Let's look into the impact of these transitions on the finances market. The shift from traditional benchmarks like LIBOR to new risk-free rates have profound implications for financials markets. So there was contractual challenges. So there are a vast number of legacy contracts which was referencing LIBOR without any adequate fallback provisions because this was a standard. So those contracts needs to be amended, it needs to be negotiated and modified to include alternative rates. There was valuations and pricing adjustments. So RFRs are generally lower than LIBOR rate due to the absence of credit risk premium. So there was a necessary to align RFRs with previous LIBOR based rates to maintain economic equivalence. There was operational challenges. There was a need to upgrade the system. So financial institutions had to update their IT systems to handle the new rate calculations. And there was a different risk management systems that has evolved, the accounting and the reporting process to accommodate these risk-free rates. There was legal and compliance considerations as well. So the new regulations needs to be adhered to avoid the penalties, and the communications to the client needs to be done and to assist them in understanding the impact that these new benchmarks will have on their uh, existing book. Let's look into the how the regulator has overcome these challenges. So there was global coordinations that that was required, and to do that global coordinations, the Financial Stability Board was established. It was leading the international efforts to harmonize the financials risk-free rates. There was regional initiatives as well. So all the financial centers have their own national working groups which were looking into establish a new new benchmark rates. The key milestone for them was that to seize the LIBOR publications, the initial timeline was for 2021, and some of the currencies got transitions from LIBOR benchmarks to uh, other RFRs, but uh, this has continued to be used till September 2000. 2024, I believe, for few of the currencies, but after that it will cease to exist. The publications will cease to exist. There was few guidelines and frameworks that was issued by regulators. Now let's look into the future outlook. The evolutions of benchmark rate is an ongoing process with several future development anticipated. The continued evolutions, so how we can evolve the existing benchmark so that it becomes a forward looking term rates based on RFRs for products that require them. There was market adaptations as well to increase the liquidity and acceptance of RFR linked products in the financials market. So there was the technological innovations that is required as well to leverage the new fintech solutions to streamline the transitions process, including the automations and with the use of data analytics. There is a need of new risk management tools to manage the risk associated with new benchmarks, and there was global harmonizations that is required as well to analyze the methodology align the methodology across jurisdictions to facilitate international finance and reduce complexities. So in conclusions, what we have learned is that the evolutions of benchmark rates from traditional indices like LIBOR to new and more robust RFRs makes a significant shift in global financial landscape. These transitions is driven by the need for greater transparencies, reliability and compliance with regulatory standards. While the changes presents challenges, it also offers opportunities for financial institutions and markets to enhance stability and trust. The key takeaway from this was the necessity to change. So the manipulation scandals that uh, happened in LIBOR, that has decreases the trust in the systems, and the declining interbank lending rate after 2008 financial crisis also highlighted the need for new benchmarks. Okay, embarrassing the evolutions of financials rate, the benchmark rates is essential for integrity and efficiency of financials market. By proactively adapting to these changes, stakeholders can contribute to a more transparent and robust financial systems that better serve the global economy. Now let's look into the references that you can look into for to further understand these uh, benchmarks. So there is a financial stabilities board reports which published the reports on benchmark rate reforms. There is the international swap and derivative associations that provides the guideline on fallback provisions and protocols. There is a regulatory publications from Federal Reserves, publications on SOFR, Bank of England, publications on SONIA, and Euro Central Bank informations on Euro STR. There is a industry reports as well, which analyzes the major financial institutions and its impact on benchmark transitions. There was academic papers as well that studies the interest rate benchmarks and the financial market implications. To further understand the evolutions of these benchmark rates and its impact on Indian monetary policies as well, you can follow my blog on the media. I have published the blog link and the quiz in the descriptions as well.